supporting these, you might say, these science fiction models, financially speaking, because there is no finance in them. The models that central banks use have no banks, just let that sink in. Supporting these science fiction models is fictional history, is a history where people in primitive times supposedly bartered and then hit upon the idea of starting to use lumps of gold or shells or whatever to replace the cruder barter trade, and then later on credit came, which is money lent out. In reality, I mean, there's absolutely no historical evidence for this story, which you can read in many textbooks, and I'm sure many of you are aware of this. In reality, it's exactly the other way around. So moving away from fictional history supporting science fiction models, let's look at reality in order to build science of economics for the real world. These are not people in the dock, these are not criminals, these are top economists testifying for the US Senate in summer 2010, hearings under the title of Building Science of Economics for the Real World. Can't remember whenever US Senate had been interested in this topic, so it's a great time to be an economist. Doing that requires that you're interested in reality. And the reality shows that credit and debt relations have existed as long probably as humanity exists. If we go back to the oldest known civilizations, highly developed civilizations of Babylonia and its predecessor Sumer, Michael Hudson and others have done great work in this area. Over the last 20 years, a lot of research has come out which shows how sophisticated the credit systems really were that these societies had. What you see here is one of the oldest IOUs, debt tokens, a clay tablet called a shubati, which have been recovered in their thousands from the temples of Babylonia and Sumer in the desert sands. And they specify the debt, the debtor, the creditor, the date, what is due, interest sometimes. There's a whole institutional and regulatory framework around that. So I think Albert Einstein said that humanity has made three great inventions: fire, the wheel, and double entry bookkeeping. So that's not a modern invention which followed money. No, money followed credit relations when credit tokens like these and tally sticks and others began to circulate as means of payments. That was money, followed by coins. Coins came much later than that. Most credit today, the overwhelming majority of credit flows, is for asset and property sectors. And economists like Marx, Schumpeter, Keynes, Minsky, Gottlieb have drawn attention to this, and attention also to the importance of this in our time. People like Richard Werner, Michael Hudson, Steve Keen, and others, Gottlieb, have explained why this matters. We have known that since Schumpeter. The Babylonians knew it actually, but we've known it as academics since Schumpeter. And most of our credit system does not support economic growth in the sense of supporting transactions in goods and services. Most of our finance system, most bank loans, support transactions in assets, increase asset prices, and increasing asset prices has a number of detrimental effects on the economy. It also is helpful to the economy at low levels, but not at the levels that we know. The financial sector is a creditor to the real economy. The real economy is a debtor to the financial sector. It needs to service all the financial obligations and loans and so on. And therefore, each month, if we look at income, household income, that's not disposable income, not even after tax. Each month, a large drain of money out of the economy goes to the financial sector, servicing loans, all kinds of financial obligations, investments, and so on. The US non-bank financial sector is now 3-4 times larger than it was in the 1980s. Do we really need all the 3/4 of the growth since the 1980s? Apparently, we think we do, because all our policies nowadays are geared towards saving the banks. And John Kay has written a book for people who are not in the industry, but of course all the decisions are taken by people who are in the industry. And their first idea, their first thoughts are always about how do we save the industry. My suggestion is we shouldn't want to save the industry. Just go back to credit and debt. Go back to Bronze Age economics. Every financial claim is a debt and is a drain on the real sector. It may be worth to have that drain. It may be worth to have that debt if it gives you extra diversification of risk or whatever. But it's a cost in any case. It's a cost. Do we really need that cost? Does the benefit justify that cost? Austerity itself is not a solution. So one way to shrink the debt is austerity. I'm not sure that it works because the GDP will fall faster than the debt and you end up with leverage. a lot of studies on IMF programs, which in the past adhere to very strict austerity, and I'm told they sometimes still do. A very large number of studies shows that this doesn't work. It has been tried in Africa, Asia, Latin America. It's come home to Europe now. Stop it. It doesn't work. Nor is QE. Okay, people who understand quantitative easing, which means that central banks are buying back their own bonds and increasing reserve balances of commercial banks in return. The idea is that the commercial banks get money from the central banks and pass it on to the public and stimulate the economy. Now, that's not what happens. That's not at all what happens, because lending to the public is not something that is the same as reserves with the central bank. It's not even stimulated by reserve with the central bank. You can clearly see this in this paper that I did with Jeffrey Gardiner. You can see an unprecedented increase in Bank of England reserves over 2009, a quadrupling, unique in the 3-century history of the Bank of England. And you can see the blue line, bank loans to the private sector, just continuing their downward way. We're doing the exact opposite here of what we're supposed to do. We need to get more credit to the real sector and less to the financial sector. Austerity starves the real sector of credit. It's the opposite. Quantitative easing kind of measures, they have other purposes, but they flood the asset markets with credit. It's not a coincidence that we have excessive speculation in food price commodities right now. All this money is still around. It wants a return. It's chasing commodities, is doing harm to the real sector. We need to get rid of it one way or another. If we let nature run its course and do it spontaneously, it will be very painful. We need to do it in a managed way. In der Beschränkung zeigt sich erst der Meister. We need less debt, and then the financial sector will function better. And it actually continues with und das Gesetz nur kann uns Freiheit geben. You can only do that with regulation. Thank you very much.